Alright guys, so chapter 8 is on fund distribution, the broker channel. Okay? So we're going to talk about the overview of fund distribution. There's a lot of different ways mutual funds are sold. We can talk about this for a minute. How do you guys think mutual funds are sold? Where would you guys go to buy them?
Supermarkets.
Yeah, mutual fund supermarkets, like what?
E-Trade.
E-Trade, Charles Schwab. What else? Scott Trade, these are all mutual fund supermarkets, right? T. Rowe Price, another supermarket. I point to you because you had a good answer last week. What did you used to have to do when you wanted to buy a mutual fund?
You had to go to the bank to...
What's that?
You had to go to
You don't remember? No, you used to have to deal, before, 2000, 1999, 2001, 2002, before like E-Trade existed, what did you have to do? You had a couple things you could do. What could you do before then?
Over the phone?
Over the phone, who would you call? You could call your broker, and your broker would have access to what?
To your portfolio?
Oh, of course. What else would he have access to?
Your money.
Your money. But what about the other side?
To
He
buy
would have access to a lot of funds, right? The broker would have access to a lot of funds, and he would sell you those funds, right? Why would he sell you those funds? What's in it for him?
Commission fees.
Commission fees, right? Now, we'll talk about this in this chapter, but the broker has different incentives, right? What's the broker's number one incentive?
Commission.
No, profit.
Okay, I heard no one said client satisfaction,
No, they want that.
Oh, please.
right? Do you think that's important to a broker?
No.
Really? You don't think it's important at all?
No, so that's the facade they put on.
That's the facade, right?
Yeah, but the real idea behind it is, let me fill up my pocket.
Okay, but one kind of goes
If they make money for you, they're going to make money for themselves too.
exactly.
And they want you to come back and do business with them.
So at the end of the day, the guy or the girl, does want to put money on the table for him, right, or her. But if he or she keeps on selling you crappy investments, what's going to happen?
You're not going to come back.
Never come.
You're going to can them, right? You'll be like, you know what, I'm transferring my account, right? So the broker does actually have an incentive to service the client, but they have some leeway, right? Now, funds will often have, or brokerage firms will often have their own products, right? And outside products. Do you think one's more attractive to sell than the other? The in-house product versus the product, the fund that was developed by another firm?
Maybe the in-house product is more lucrative for the broker.
It depends, and that's what I wanted you to say. But the answer depends on the incentives how the different funds.
Plus, in-house is going to probably try to give you more.
Right.
money.
But an outside broker, an outside mutual fund firm might increase the incentives to the broker and say, hey, if you push our fund, we'll double your commissions. And then all of a sudden there's a push to sell that fund. So if you're looking for an investment in the emerging markets, they might push you to the fund that they make the most money on. Which is then the important question, is that's when we look at fees, right? Because in theory, you would expect the broker to be making the most commission off the funds with the highest fees. So that's when you as an investor would say, oh, talk to me about the fees in this fund. What are the fees on this fund compared to the competitors, right? This is talked about in chapter 9, chapters 8 and 9, which is why I try to cover them in one day. It's all about distribution of funds, right? There's also the direct channel. What do you think the direct channel is, if you haven't done the reading?
It's like when the investor pulls directly to their fund. But they cut out the middleman.
You cut out the middleman. You go right to the mutual fund firm, and you're like, you call them up on the phone, which seems very uncommon and weird nowadays, right? You call them up and you'd be like, yeah, I'd like to buy X amount of shares of this fund, right?
Can you still do that?
What's that?
Can you still do that?
Yeah, you can still do that. It's not as commonplace anymore, though, right?
That's not too good because you might choose the wrong mutual fund investor.
Brings up another great point when we're going to talk about the brokerage channel. What else is a broker? If you went the direct channel,
You must know about it, like. did
There you go,
research
right?
to
You
cover
you might have your own background in this field. You might have already done your own research, right?
Yeah.
What are you really paying the broker for? But through your commissions.
For their research.
For their research.
And they still charge you some money.
I was looking very negative. but playing the devil's advocate here is true. You know, I mean, I know I haven't showed you guys any like really happy-go-lucky videos on mutual funds or banking. All the videos I've showed you guys have been very negative.
Yeah, evil.
Don't get me wrong, I want to be on the other end, getting those commissions.
Yeah, me too.
But I'm just stating a fact.
Yeah, but it does go hand in hand. You know, did you guys hear the story about Goldman?
Yes.
The guy who quit Goldman? You guys didn't read about it? It was like a big story in the news.
I kind of heard it in the news.
We can talk about that. We'll talk about that off camera.
Yeah.
Okay? Not just so when I put this on the web, it's 3 years from now, this topic will still be relevant. We'll be like, what is he talking about? Anyway, so going back to the slide, distribution is the process of selling the fund to investors. Pretty straightforward, right? Most funds sell shares every day to meet liquidity needs for redemptions, and when we talk about most funds sell shares, right? They can sell shares. They're talking about selling shares. Like, why am I going to sell my shares back to the fund, right? I'm selling them because I might need cash. You know, they want to keep their funds growing. Fund growth helps achieve economies of scale, at least in theory, right? If we grew our fund, what does that give us the ability to do from the point of the mutual fund owner? When we're a startup mutual fund, we don't have the ability to have our own in-house custodian, right? We will outsource that, and we'll pay a premium for that service, right? Because we only have a staff of 5 people. Same thing with like printing up materials, right? We're not going to have one person print up massive amounts of material once every 3 months for the investors, right? We're going to outsource that. But once you get really big, maybe you have, $100 million in assets, or $200 million in assets, or $1 billion in assets. Then you might say, all right, you know what, we can afford, and the person's time will be well used if we have somebody in-house. We're going to buy the big printing machine, and we're going to hire somebody full-time to take care of the printing of our materials. And that sounds like a really simple job, like who would want to be in charge of printing our materials? But there's 3 people at my work who that's pretty much their job, is to print stuff. And they get paid I don't know how much they get paid, but from what I imagine, they get paid really good money to print stuff and bind it together and put it in the mail, right? Not the most glamorous of jobs, and not probably where they want to stay for the rest of their lives.
No.
But it's an important job. Why is that job so important?
Regulations.
Important information.
What's that?
Important information.
Important information?
Regulations requires them.
Regulations required, it has to go out, right? Quality of work, right? We had this one guy in my company who couldn't put a book together with even pages. Like they would all look like this,
Alright, so.
Can't do that. What can you do, right? And this is the information that goes to clients. At my firm, the minimum entry point for a client is like $10 or $25 million to invest, right? So if you're investing that kind of money, the least you want is the information to look pretty, right? You want it to look clean. Some funds can grow too large to continue to pursue its investment objective. So some funds have limits. Why do you think a fund would have limits?
Not to affect the market.
Because it would start to affect the market, right? And other examples would be, there's other regulations that we talked about earlier in the class and in the book about there's only a certain percentage a mutual fund can hold of a certain stock. And if you hit that limit on a few different stocks in your index, you run into trouble. You have to close the fund because there's just no room in the fund because you can't, go over those regulatory limits. Also, it could hurt your strategy, right? We might have a financial model for a strategy in the S&P 500, right? The S&P 500, what would we say about the S&P 500? How would we describe its characteristics? Don't worry, I'll do it for you. It's broad. It's liquid. and there's tons of volume that goes through it every day. If you want to sell stock on the S&P 500, you'll be able to sell it in tenths of a second, right? If you want to sell a share of a company in Uganda, it could take a week to sell it, right? That liquidity has a direct impact on, can have a direct impact on the size of the fund that you can actually manage, right? Because you might not actually be able to buy more of these shares. The capacity of the fund might not be able to handle your strategy anymore. Where then, with you buying additional investments in your strategy, could artificially raise the price, which wouldn't really benefit anybody, because the second you tried to sell, guess what? The opposite problem would happen. You'd be controlling the market. So when you started to sell your investments in your fund, what would happen? The price would tumble. And all the returns that look good on paper are just, that's it, they're paper returns. You're controlling the market. There's no sellers on the other end when you're buying, and there's no buyers on the other end when you're selling. Yeah, exactly. Early on, most investors paid an upfront fee to purchase shares. This is called a front load. Okay? So you're paying the commission upfront. That works out good from a business point of view. Why?
No matter what happened in the fund, you still get paid.
Yep. And then when you're paying the brokers, right? If I pay the brokers, right, and the customer pays a front-end fee, guess what? The mutual fund gets the fee, and then we distribute it to the brokers. Pretty straightforward, right? But if we had a back-end load, what's a back-end load? When does a back-end load occur? And I think the book has another name for it as well. It's like CDSD. You guys can look that up. What happened? What's the back-end load?
Based on performance.
Nope. If a front-end load is the fees charged when you buy the fund, what would a back-end load be?
What's the trading profit?
You get charged the fee when you sell. Now, when the broker sells your fund, right, you still have to pay him a commission. But if the way you have your fund set up is that you don't get your commission until they sell, well, then you're in a little bit of a pickle, right? In terms of, cash flow, right? You know you're going to get the funds, the fees eventually.
But they can hold it for a while.
But if they hold the fund for 5 years, I mean, that's great, because you're still collecting maybe some other underlying fees, some kind of, generic management fees. But we're talking about distribution fees here, which are different than management fees. Okay? No load funds grew in popularity due to the growth of money market funds and growth of 401k plans. Now, when they say no load funds, guess what? No load funds generally have a 12b1 fee, right? So it's a no load fund. So on the surface, it's like, oh, no fees. But there's an underlying 12b1 fee throughout the fund that's continually charged. During the 80s, load virtually meant it was sold by a broker, and no load meant it was directly marketed. So when we talk about the advantages to going through a broker or going direct to the fund, oftentimes when you go direct to the fund, guess what? You don't get charged the load. But when you go through a broker, you do. No load funds paid for their distribution through management and advisory fees. So that management fee, which would a lot of times be like between 1 and 1.25%, they would take some of their cut and then give it to the broker for selling the fund, if they sold it through a broker. Okay, Rule 12b1. Okay, was enacted by the SEC in 1980 in response to the argument that increasing the fund, a fund size was a benefit to shareholders. Okay, is that true? You ever hear like those commercials for like couches, like we pass on the savings to you, right? That's in theory. That's the argument. Is that we're gonna charge you this extra fee. Now, when I say it this way, I'm gonna be doing an awful sales pitch because I'm a little biased, right? We're gonna charge you this fee to help sell more of the fund, to help eventually lower your fees, because our fund will then grow in size. And then by growing in size, we'll have economies of scale, and the fees in general will be lower. Do you buy that? No, but that's kind of what happened here, right? That's the long and short of it. Again, I'm arguing, I think, from the more rational point of view here. 12B1 fees are distribution fees and are no more than 25 basis points paid annually. Okay, what's 25 basis points? 0.25 what? Percent. Good job. Okay. Could be used to encourage brokers to leave money in the fund. Okay. So they could use these 12B1 fees to help pay the broker's commission, right? To help brokers give them incentives for people to leave the money in the fund, or for to sell people the fund, right? Think about this. The 12B1 fees can be used to give brokers incentives to keep money in the fund. Now, are the brokers really keeping money in the fund? Or are they trying to keep their clients' money in the funds? Right? So, if the broker is getting a consistent fee from his clients, just having their money sit there, easy money, right? All I have to do is nothing to make sure I get this continued revenue stream. Now, the broker isn't going to get 25 basis points. You know, he'll get a small portion of that. But that's the idea of it. And then once you have a certain amount of clients and a certain amount of assets under your belt, you know, 0.25% or even 0.05% can be a significant source of income once you hit a certain mark. So let's say it's what's 0.05% multiplied by 25 million? No one of you guys can do this in your heads.
What?
Calculator? You guys all have iPhones. 0.05, so that'd be 0.0005 times 25 million. 125?
Yeah.
Right? So if you were a broker and you got 0.0005, so 5 basis points, and you had clients that had $25 million in their retirement portfolios, you could potentially have this income stream of $100,000 a year, right? But then maybe your company takes a portion of that, blah, blah, blah. But that's not a bad living, right? No. Okay. 12B1 fees can be used along with back-end loads as well. The SEC voted to change 12B1 laws significantly in July of 2010. Does anyone have a tissue? I'll wait till we're... Feeder funds. Funds can have a master feeder fund that branches off to separate parts so that they can be sold through different channels. I wouldn't focus too much on that, but here are the different types of non-proprietary and proprietary are two I want you to focus on. So from a broker's point of view, proprietary fund is a product that's in-house. It's something that's developed by the brokerage firm or by a subsidiary of the brokerage firm. Non-proprietary funds are everybody else. So if I have a brokerage firm and it's like Mike Collins' brokerage firm, and I'm selling PIMCO mutual funds, right? Those are non-proprietary. Those are not developed by me. I'm selling them for somebody else. They're non-proprietary. But if I have Mike Collins' brokerage house and I'm selling Mike Collins' mutual funds, those would be proprietary to my firm, right? The direct channel, we already went over that, right? What's the direct channel? Cut the middleman off. Call the mutual fund firm directly. We didn't get into bank funds yet. Institutional funds are a little different because they generally have higher limits and lower fees, right? Because if you're an institutional investor, well, let's start with, if you're a retail investor, there's usually different levels of retail investors. Like they'll say, all right, we have these Admiral class shares. You have to buy a minimum of $25,000 worth of shares, and the fees are lower for these shares. Nothing else is different, just the fees are lower. And then we have our generic shares, where there's only a $500 minimum, and the fees are our regular fees. Now, they might have an institutional class of funds, where it's the same strategy, but the funds require a minimum purchase of $1 million, and your fees are even lower. Now, why would they do that? economies of scale, right? If you were going to buy one car, you would expect to almost pay retail price. If you were going to buy 3 cars, you'd probably get a decent discount, but you're not buying, a lot. But if you were buying 100 cars, what would you expect? Big discount, right? So same thing with an institutional investor in mutual funds. If they get, if they invest a lot of money, it's a way that they can kind of knock down the fees significantly, right? And that brings up the point of economies of scale again. A lot of times, especially if we're talking about like a startup fund, right? To get your first client, you might offer them very low fees to be your first client. Why would you do that? Well, a lot of times, my firm is having a problem with one of its funds just getting money in the door for only one of the funds. And the reason is because it's something that we usually don't specialize in. It's a new product for us. We're an active equity shop, and the fund that they're trying to sell is a debt fund. It's a bond fund. It's an emerging market bond fund, which are emerging market bond funds have done awesome this past couple of years. But it's hard to sell that because we're an equity shop. So what do? How do you get your first customers in there? Well,
You can hire another firm to do it for you.
you could hire another firm to do it for you, right? And that would be sub-advisory. That's what that's called.
You can lower your fees.
Lower your fees, which tends to be what happens. Next, we have insurance, affinity, exchange-traded funds, and exchange funds. We'll talk about those later. Underwriters, distributors, and wholesalers. Okay, funds hire an underwriter to act as a principal or an agent to sell their funds. They can also be called the distributor. Distribution covers 8 issues: procedures and conditions for selling fund shares, procedures and conditions for purchasing shares, registration requirements, states blue sky qualifications, other duties of distribution, allocation of costs, duration, termination. So they're almost like contractors to sell the fund. I won't ask you any specific details about this for a quiz. May distribute through its own representative or another third party. The dealer determines the suitability. So the fund itself is what they're saying doesn't determine who's a suitable client. The broker, for our case in point, determines the suitability. So if I'm the client, then let's say I'm like 65 years old, right? Are they going to recommend an emerging market debt fund for me to invest in? Why? It's too risky, right? That wouldn't be, he wouldn't be acting in my best interest because that wouldn't be suitable for me, right? Loan fund distribution via brokers. In 2004, 36% of funds were distributed by brokers. This includes financial advisors. So we talked about financial advisors before, and what do financial advisors do? For the point of this class, they act in a very similar way to brokers, right? Why are they similar? What do? They offer advice, right? And they sell you funds. And they offer you products. Some are proprietary, and some are non-proprietary. Look at I know they might have changed their name, but like MetLife or Ameriprise, or there's another big one that I can't remember right now. What are they doing? They're offering advice to clients, and they're making fees, and they're trying to match their clients' interests with their financial needs in the future. The non-proprietary channel sells funds that are produced outside the firm. We already went over that. Proprietary funds are produced within. Non-proprietary funds generally have a load. More than half of proprietary funds are no load, right? So there's another significant difference. You could sell it to a client and say, hey, we have a similar product, the one that you're looking for, and we make it in-house. Similar strategy, and the fees are much lower because we make it in-house. So they might try to push you in that direction. Why? Well, because there's a cost saving in it for you, and there's a benefit in it for them. Now, you might say, no, the reason I'm picking this particular fund, even though it's more expensive and not produced by your firm, is because I really like the portfolio manager, or the portfolio manager there has done really well. I have more faith in that firm. The role of broker is the same, to get you to buy funds, right? Load schemes and broker compensation. This is important, right? Different class classes of funds are generally just different fee structures. So when you see a fund that has different classes of shares, it's generally just to differentiate the fee structures. So you have A class are front-end load. Generally, this is like, there's no hard and fast rules, but when you see in a Class A fund, it's generally a front-end load, B are a back-end load, and C are a level load. AKA is going to have a 12B1 fee. Front-end loads take a percentage of the fund purchase price. Be familiar how to calculate a front-end load. I won't have you calculate a front-end load. I just did that for my online class because try to make the online quizzes a little bit more challenging. Okay. Contingent deferred sales charge, CDSC. That's just a fancy way of saying back-end load. I will not ask you to define CDSC and tell me it's a back-end load. I want to have something that obscure. The fund distributor pays the broker commission up front. So from the business point of view, the mutual fund firm will pay the broker up front, but will wait to get the commission on the back end, right? Now this distribution commission is separate from the management fee, okay? Level loads carry a perpetual 12B1 fee. Usually, that's wrong, sorry. It's only 25 basis points. I apologize, that's a mistake on there. And this is 12B1 fees are controversial, and they are going to change as of July 2010. Part of your homework this week, I'll give you a preview, so you don't have to look on. Well, you will still have to look online, but I'm asking you to summarize the changes to the 12B1 fees. Yes, sir.
You're not going to put any homework on week 7, right?
What's that?
You're going to leave week 7 blank, right?
The one that I left blank?
Yeah.
Yeah, that was a gift. Okay. Non-proprietary funds get less shelf space. The line between the different channels is becoming blurry. Okay, so that makes sense, right? If we're going to Best Buy, I don't think Best Buy sells their own branded cameras, but I'm trying to think of something that sells their own branded products. Trader Joe's, right? Trader Joe's sells mostly Trader Joe's stuff. And where do they put the Trader Joe's stuff? Front and center, right? They want you to buy their own proprietary products. And the third-party brands, and this goes with Stop and Shop too. Stop and Shop has their own CVS. They put their own in-house brands more up front. They want you to buy their in-house brands. Why? Because they're more profitable for them, right? And the non-proprietary brands might be placed underneath on the lower shelf, or just in a more inconvenient space. Does anyone have any questions about the load schemes? This is something I will eventually quiz on. What's that? Okay. Issues in broker distributions. Do investors understand the complex commission schemes? What do you think, Peter? No. Most of the time I would say they don't. Most of the time I think most retail investors just look at the bottom line. How much money did the fund return? In fact, I think most retail investors aren't even concerned with the benchmark, right? If their fund performed 7%, they'll be like, oh great, I made 7%. But if the benchmark made 10%, they don't even worry about that. You know, that's the difference between a lot of retail investors and institutional investors. Even though retail investors should care about that, if a fund's benchmarked, which most funds are, it should be exceeding, if you're doing well, that index. Now, not every fund is going to exceed their benchmark month in and month out all the time, right? But it's just another consideration, another difference between retail investors and institutional investors. Do distribution features cause conflicts of interest? Yeah, absolutely. You might even believe that another fund that you can sell is a better fund, but you might make twice the commission on something else, right? They could have financial interest in selling you a mutual fund that will benefit them more. Different classes of shares are more appropriate for different investors. They also offer different commissions. So we had the class A, B, and C shares, right? If the mutual fund brokerage firm thinks that you're going to keep the money with them for a long time, they might say, hey, you know what? We'll throw them in the class C, no load, where they just get that continual 12B1 fee perpetually. And if they have you in their portfolio for 20 years, they'll eventually make a lot more money than if they just paid the front end load. The commission's all up front, right? So generally with the front end load, it's just the front end load. There's no 12B1 fee with the front end load. But with the back end load, there can be a 12B1 fee, but not always. And with a no load fund, there's always that level 12B1 fee. So that's a different commission scheme. That's basically how it works. So some people, you know, and the back end commission can change too. They can have different levels on the back end commission. Now, if you keep your money in the fund for more than 3 years or more than 5 years, they might say, all right, there's no more back end commission if you keep it in the fund for X amount of time. Why would they do that? Because they're continually making their annual management fee, right? Now you guys hopefully have a better understanding why fund fees can be so confusing, right? And why there are, if you look into this kind of stuff, why there's a lot of complaints about the complexity of mutual fund fee structures. Because you're like, wait, I thought there was a management fee, and then now there's a distribution fee, and go ahead.
Why would they do that? Why would they like tell you that you can only keep it for 3 years as a back end, and then if you don't take your money out?
No, they wouldn't make you take your money out, but they're saying, all right, we charge a 3% back end load. But if you keep it in the fund for more than 3 years, the back end load is now only 2%. And if you keep it in the fund for 5 years, then there's no load at all. We don't charge any commission. It's an incentive for you to keep your money in the fund a longer period of time.
I thought you meant like they charge you more if you keep it in the
What I was saying is that the front end load, all the commissions are charged up front, right? One time, boom, done.
Yeah.
But if you if you are in a no load fund, which a no load fund is kind of not really, even though that's what they call them, the name is, what they really are is a level load fund. They charge a lower fee every year, continually. So in some cases, you would, if you kept your money in the fund for an extended period of time, you may have been better off paying the front end load and paying it, just getting it out of the way, as opposed to paying a 12B1 fee
because it
forever.
accumulates longer.
Because it accumulates longer. Yeah, exactly. And that's the end of this chapter, so I'll pause it right here.